One down and two more to go this week with big bits of news that could shock the markets. And as we know, Fed Day is upon us, with Powell potentially raising rates 25 basis points. The economists say this isn't possible anymore since we've got the inflation numbers. They were down, but they were sticky in the core. So what will the Fed do? That is the most important aspect of really your trading this week. And as we know, Powell has a pretty bad track record with the last 5 of 6 Fed days being negative. The question is, will it become that way again? Well, today we discuss the data points around this, and also we talk about everything to do with stocks, commodities, and cryptos moving forward. Will we get further bull runs, or are the bears just waiting on the horizon? I'm pretty sure we'll see a catalyst over the next 2 weeks. Let's talk about it. Well, welcome back everybody to the Daily Show, where we talk about markets around the world. Of course, we'll be covering the latest macro news, leading indicators, and the hottest charts coming your way today. If it's your first time here, welcome to the community. Remember to subscribe and smash that like button if you find value in today's video. I'm sure you will. So let's begin here with down the last 5 of 6 days. Now, Fed Powell has changed it up a little bit. Generally, when you've had these Fed days, you've seen a lot of bullish moves, and that was certainly the way in 2022. But in the back end of 2022 to 23, things changed. And what I wanted to show you here was the difference between rate cuts, holding, and in general, any kind of raise. Now, obviously, it would make sense that if you get some kind of cut, generally speaking, after a post meeting, you see a huge rise in markets. Why I want to mention this chart though is just to show you that the first move is often the false move. We even saw it kind of in the stock market, especially with the NASDAQ over the last 24 hours. It rallied hugely, then sold directly off, making a new low, and then rallied up for the end of the day. We've got our thoughts on that a little bit later on. But notice that any type of raise generally will dump the market after hours and also continue to close it lower. And any type of hold, actually the statistics with the hold are very neutralized sessions. Interesting, a run up with a neutral. So great stats there. And you can see that, of course, Powell's trending statistics are currently post his discussion turning negative and pre potentially a little bit positive. Keep in mind if you see the right things if you're a scalper and day trader. Another thing that I think that we are worthwhile paying attention to is some of the data points of some of the different systems that people are using out there. Here's one that's been shared on Twitter by Mo, and you can see here it's basically just an idea of having like a consistent 42 bar trade period and whether we have toppings and bottomings in these markets. Interestingly enough, on June 14th, look where we arrive at 42 bars, obviously a period of time where we might be seeing a topping in the market. And it's just one of many reasons why we could potentially be seeing a topping. Please remember, whenever you're thinking about a topping in the market, there are key points. Of course, on this channel, we talked a lot about 4,200. Once we broke 4,230, the next equilibrium zone was 4,300, 4,350. Little wonder why we find ourselves here. During those periods of price readjustment, you really don't want to be trying to fight the market trend. But we are starting to see the signs, but not the activation of a turn. Here's another one that we shared in the previous video, 50-day moving average spread, extreme overbought conditions. Now we're 6 straight days in a row. Is that a worrying sign? I would say yes. And of course, we're sticking to single stocks and sectors at this point over indices as probably the most preferred trading tools, and even potentially most preferred investing tools, as there's still some pretty deep value in markets if you know where to look. Let's move over to, of course, the calls, the overwhelming calls. They're getting bigger and bigger and bigger, and this is symptomatic with every single major sell-off since 2020. When we see this many calls come in and we move to a standard deviation away from normality, well, it's a worrying sign. And it doesn't just stop there. There's also a few things that we shared over on our Twitter as well. But let's first begin with June OPEX weeks. Some statistics here for anybody that's a boffin with statistics. The pre generally has been down the last 2 years. Of course, no real notable negative statistics here. But interestingly enough, more negativity usually the week after. That's after this week finishes. Post-week June OPEX, that is the quadruple witching, tends to be actually negatively biased, but nowhere near as much as September. Keep that one in your mind. Here's where I think things start to get a little bit worrying. Take a look at the massive difference between S&P 500 retail volume in the trade. It's back up into the 12s here, and that's a huge change. And if you look at some of the points where we've actually hit these kind of high periods, you might notice a trend. We hit it at the beginning of the end of January into Feb. We sell off soon after. We hit it, of course, over here. We get a little sell off in the markets. And when you're coupling that with the amount of calls that are in the markets right now, you can start to see a bit of the trend overall. First up, was the inflation figure any good? On one hand, yes, we saw energies, of course, drop across the board, but I think the things that I was looking at mostly were shelter. We know that shelter tends to be one of the stickiest forms of inflation, and both shelter and food were both up over the period, along with used cars. And I think that's really showing you that huge amount of over demand and still that the Fed has work to be done. In either case, I think that we're very close to either pivoting or at least holding for a very, very long time. And my guess here on the channel has been for a while that we are not going to see a cut in 2023 by the Federal Reserve. We might actually find that to be the problem over the next 24 hours if they release again saying we are not cutting. This whole thing is basically going to be, we're going to look at the data, be dependent, all the normal stuff. Maybe it triggers the market to freak out. You can see here over when we talk about month-on-month shelter, it's not really improving. And this is a problem that I believe the Federal Reserve will be looking at very closely. It's also got to do with their high interest rates as well, though, driving up, of course, the amount that you have to pay on a house in terms of repayments and therefore driving up rents. It's kind of like a self-fulfilling horror prophecy. Let's move over to fear and greed index, extreme greed. I don't think that's going to surprise anybody. Do these reads mean that you should sell the market instantaneously? Absolutely not, but certainly shows you you've got all of the signs that happen time and time again. It's kind of like this one. I'm waiting until we get a new survey report. I don't believe it'll come in at 44.5, but usually around 2 weeks after these survey reports, 1 to 2 weeks, we tend to see a topping in the markets if they go super hot. I expect another 30+% read. And if we do get something like that, then I think we're in for a little bit of trouble in terms of potentially getting a mean reversion. Here's another way of looking at kind of the general optimism in markets right now. No problem being an optimist. You should always generally be so. However, as you can see here, we're in the danger zone. And this is a market where I think it's like this. The bulls are too scared to open new positions potentially, and the bears are too scared to short the market. It's a very interesting paradigm shift in the markets that you don't see very often. But when you do get to these points, often the unexpected can happen. And more importantly, you have to really be open to both still rallying and moving further away from what you believe is the relevant, like a possibility. And also when we get a switch, you need to understand that there's more than likely a swing trade starting to come through because we are far away from mean reversion. So the S&P 500 after exiting bear market territory, we talked about the next 3 weeks being shaky. Of course, so far so good for the markets. Will we start to get some of these stats? So at the moment, we're running a pretty nice percentage green, which is actually fairly rare when you think about it. But 2 and 3 weeks also have those bad stats with them. This is just stats. They're not lying to us. It is what it is. Move over to the forward PE. We're probably sitting at around 18.4 at this time, maybe even 18.6 on the forward PE. Is that cheap for investors? Not really. Is it expensive? Not really. It's just a little bit higher. You could see more growth before it gets worse. So certainly investors could look at that. For me, myself, I actually prefer to get like a 16 into the 15s for that particular read, and I'm always looking at it. Are we following the normal track of a pre-election year? Theoretically, yes. We're in the middle of June at this stage. Often we see a little sell-off at the end of June, and then we get that one last run. Q3, often considered the worst part of pre-election years, is usually where you get that sell-off. I expect this year to be worse than normal, so it's not going to be like, a few percentage like this. It's going to be a full mean revert, I would think, back to the weekly 20s at least. But this is the type of thing that you're looking for in markets, and of course, you must get a price action change of trend. Let's go over to our lead indicators here. One of those being, of course, the top kind of stocks, and this is just a combo I've made. I'm looking to see whether we've got a weakness in the big tech stocks that have led us out of this problem. Well, it looks like we do. And of course, on the weekly, you can see here we're very far away from the mean reversion, which just so happens to be an incredible demand zone as well. It's about 14% away. No new high, while the NASDAQ, the S&P 500, and the Russell all tried to do it. And of course, the Dow was there as well. Move over to what we're seeing in terms of rotation, the NASDAQ versus IWM. It actually had an okay session with it, but again, it looks like for the moment, NASDAQ will probably slightly underperform the smaller market if we continue in this bull run. and I would say the Russell would look better. For bears, you haven't seen your skew crush yet. I expect skew crush to happen after this FOMC meeting. This will be a big one, and hopefully we get skew crush. This is often considered the black swan indicator. When it's super high, you can't sell. When it does get crushed like this, we need price action to be on our favor, and we've talked about this several times. Skew crush, not here. Not yet, anyway. We're also not seeing a slowdown in the calls. Put-call ratio just going into the dirt. Now one of the lowest readings we've had in some time. Kind of reminds me back of this November period. We need to usually see this turn and then price action will turn at the same time, but we haven't got that yet. So again, it is not a sellable market unless you're guessing, and I don't really like guessing too much. I would rather react to the market rather than predict its topping here. In terms of where it is right now, we could say, yeah, it's at a pretty good zone, but frankly, the S&P 500 is not at a key resistance, really. It's in the middle of nowhere land, while the Qs are at a key point. So maybe the Qs hold the key here. VVIX, increased volatility, expectation. This is the volatility of the volatility. Well, yeah, you would expect that into the FOMC, and the most important bit of news, which is, of course, whether we get a rate hike or not. In terms of breadth and movement, this is a positive sign, a nice 24 hours for RSP. I wouldn't be surprised at all to see RSP actually overperform the market moving forward. So you can actually load like an RSP SPX code, and what that will realistically show you is that the equal weighted market has been underperforming for quite some time. You can see here, very, very horrible. This is a long short style strategy, and it does tend to underperform the big ones. But certainly there could be a little bit of a switch here. This is a heavy underperformance. So if we're in a rotation, guess what's going to do better? Generally, RSP will beat out the rest of the market because, of course, tech has been driving us so hard. Here's breadth of the stocks. It continues to improve. The percentage of stocks above 200-day moving average is better. So definitely for the bulls, that's a good case scenario. And here's one I think the bulls have to celebrate a little bit more about. Stupid central bank liquidity continuing to inject in. Ridiculous. And they're doing it for treasuries, I'm sure. But this is, look, you can say ridiculous, doesn't really change anything. We're still extended away. It still brings mean reversion. But ultimately, while we are overpriced and we've seen all these red periods of time give us the cheaper prices in the future, if this thing doesn't really drive down, bears don't have a chance of getting really low points. I mean, it's just not going to happen. Not if the Fed has anything to do with it, and it's ridiculous. So this is the Qs, how extended they are away. Again, the most extended I've seen them for quite some time. The last time we got a read like this, it was pretty much before the epic crash of 2021 into 22. So yeah, I mean, again, these epic crashes, we need to see these Fed bank liquidity kind of dropping down. It's not at the moment, but it's very extended away, showing us we need to be cautious in this run. These runs are big. Congratulations to SoFi pickers. Obviously, this was one that came up in our Monday stream about a week and a half ago. Since then, it's continued to run. It's hit not only my first TP, but it's about to hit the second. 980 was the second level that we were looking for. Basically, an incredible line of just bullish movement. And what this is really detailing to me is the same thing of why I mentioned Piton. I hate Piton, and I don't think anything good about this stock. But it does tend to have that kind of reaction of the retail traders to jump it with calls when, and of course it gets bad if you can't get out of it, but it jumps with calls during some of these periods of time where you get, I guess you would say, exuberation, greed in the markets, all those types of things. This has been one that's running out. There are, of course, others. Another one that notably everybody's talking about at the moment is NEO. I haven't seen necessarily the same reaction with NEO, but it was up 5.8%. Proceed with extreme caution on these. Of course, they are absolute YOLO, very scary trades. They are based on 0 DTE options and continuation of basically big players pumping along with small players to eventually leave someone holding the bags. If you don't want to believe me about leaving the holding the bags, big rallies, huge dumps. Big rallies, huge dumps. So be very cautious with all of these at the moment, but it's all the sub tiers that are going right now. So the big ones have done, now it's sub tiers. Speaking of sub-tier, we've got our little Intel here doing a very good day, 2.54%. I saw some big options on this, which we detailed here in the previous video. These options are kind of pointing towards $38, $40 pricing. This one is, I would say, a better stock than, of course, some of the others we were looking at. Now, you might say, well, Intel's the worst stock, man. It's underperformed over a very long period of time. That's true, but it has an incredible accumulation story here with great volume and everything else I love about these types of ones. You can see a very strong close. I'd like to see this one trundle up to the 38.40s over the next coming months. One that can't catch a break, but does have that kind of insistent, buy the dip kind of philosophy in it with retail traders jumping all over it was PayPal. Another downgrade on this stock, holding it back over the last 24 hours. I'd like to see this one find a bid. We'll see whether it can do so. Do I like it as an investment? Hell no. But I do think that PayPal is another one of those candidates of the Wild West out there. Did we see a movement into utilities or defensives? Not yet. Still not really extra. They're holding their ground, both healthcare, utility staples, etc. But we haven't seen a massive move into them, usually showing us that we haven't got a rotation of the big players coming out of the market just yet. Let's talk about options. Let's move over to the unusual option activity. Tesla managed to hold up to its 90-day average again. Tons of calls coming in, pushing the market up, getting close to that 262 or 4 gap that we spoke about. So congrats if you've kept holding it. I thought it might crap out at 220, 230, but it just didn't even show one sign of weakness. Again, price action is everything. Predicting those highs, even at this stage, we might think 262 is a good high, but if we don't get a turn on the markets, what are you going to do about it? You can't really attack it. Let's move over to some other ones that have found some interesting positions recently. We've got this movement in AMD that was negative on the session after they had their little, kind of like big day talking about how great everything is. That's more of a buy the rumor, sell the fact, I think. AI, 14.7%. But some notables here was Intel, of course, finding strong calls the day after we spoke about that huge position that went in. Disney continuing up its pretty strong days, 0.8%. Maybe you could say it's underperforming, but that's there. And even with so many extra volume trades on Broadcom, it kind of topped off in my opinion. Now, I think Broadcom's posted its high. I also think NVIDIA is kind of floating around its high, so that'll be interesting to see moving forward. Here are the put call ratios for everything. You can see here the calls starting to get close to the puts on the SPY. Q's still very heavily put driven, which is a bit of an issue for it to go down. And of course, IWM moving towards the call side. Interestingly, there 49.51, so pretty much flat. Let's move over to the biggest trades in these markets. And you can see here that it's still call side for the last 24 hours. No super unusual puts that I saw through the top big ones. There are a couple of puts coming through, but most of them are 0 DTEs or for this week. So nothing notable there. When we move over to stocks, you can see that they're starting to push that 260 narrative on Tesla. Biggest position of the day was a call volume, 260. And then we had some interesting ones, AMD making up the list here with people getting a little bit nuts on that, but a big put as well. And as we scroll through, you'll see some familiar, horrible hyper stocks coming through. Rivian, Neo, Nikola, wow. And then we've got SoFi continuing to make up that list as well. And as we scroll through, SoFi and Intel getting some nice big options on it on the 0 DTEs. So have a look through a list like this. It's always important to know what's going on with the 0 DTEs. I did notice that there's a few of these smaller ones that are getting a little bit longer dated. Could that mean they're about ready to go again? We'll find out. But yeah, certainly be watching the price action. Here's what the Fed, or at least the economists, think about is moving forward here for June. Now, I want to show you this because we have only a 4.6% chance now. This is priced out of the market at this point that we'll get a rate hike. Now, you guys voted on Monday that there was 26% chance of a rate hike. Take a look at July, though. All of a sudden, oh yeah, we're going to get a rate hike. Why would they pause now and then rate hike then? I guess it would just be because they're waiting to see another report to see whether it's still sticky and they don't want to attack the markets too much. Well, yeah, anyway, there you go. So 61% of economists think the rate hike's coming and they just think it's going in July and not June. So interesting point. Let's have a look at rotation coming through the last 5 days. Some super sleuths figured it out. Jets was the one. And a few of you mentioned it in the Monday live stream. Congrats if you were in that, I guess. Another nice session for Jets. Oil coming down, I guess, has helped that, and inflation coming down in those sectors. Semiconductors have now regained as the second best over the last 5 days. Consumer discretionary also getting nice rotation into it. Defensives, trash, have not found super bid over the last 5 days. And we need that to happen if you are trying to be a bear in these markets. Let's move over here to the last 24 hours. We've got clean energy, metals, which we knew to stick away from for now. Copper broke out a little bit to the upside. And of course, some of the most hated sectors recently getting their rotation And that's the type of thing you want to see with generally a market that is improving underneath the hood. Let's move over here to TLT. Nothing much going on. We know there's a whole bunch of treasuries being listed. I'm watching this one very closely. I think treasuries is an interesting investment. As a trade, not so much, but I'm looking to see whether any of these levels get hit. And I've, of course, got search alerts for that just in case. We move over to the dollar. Now, this was one that in the private community I was mentioning as the news came out from inflation. We saw this initial spike up. That was actually a pretty excellent short. It's part of our day trading masterclass, that type of entry. And that was a phenomenal little entry here. It's actually hit the target, which was that red box. It did so with a gap, actually, on the futures here. And you can see, and I wouldn't be surprised at all to get that one to fill. But dollar was generally weak off this announcement. And I think the reason it went weak was because the chance of a Fed hike went out. Now, of course, if they're raising rates, dollar becomes more sexy to own because you earn more yield. At this point, well, it's only 5% chance. If they do raise rates, you have to expect the US dollar to generally find bid over the next 24 hours. And although it's moved underneath, I could see it move back up, then possibly sell. Be careful here on the dollar. Big gap here on the futures market. Certainly one worth watching with the roll. Let's move over to gold. Gold is floating in the middle of nowhere land. So it hasn't broken out of any of our ranges yet for gold. And you can see here it's just around its little buy zone that it's come down to a few times. We know there's a lot of trade for shorts coming in around 1976 to 1980. So at this point, this is where the sellers are. This is where the buyers are. We're waiting for the news to push us to either direction to show the next level of equilibrium's on. Oil is kind of similar. The buyers sit here around the 66, kind of 80 or 67 level. Then the sellers sit around that 73. So we know it's a big trade zone here and here. We know that this has become a bit of a demand zone. I don't really like to trade this type of market, but you can see where the buyers and the sellers are. No extra information yet. In terms of a recession call, can you call one now? No. We haven't seen, of course, the economy weaken in the US, which is jobs, but also we need the US 2-year versus 10-year to go underneath what we call 1% inversion. So basically, that until that happens, statistically, you'll never get one. Just something I wanted to mention. Tesla. Now let's look at the individual stocks in the US. Tesla has moved to almost the gap level, and that is a big zone. Now, for Tesla call buys, I mean, this is already surpassed these 3 candles. Generally, that means you're in an exhausted market. And I will warn you of that. That is an exhaustive style move. And it tends to happen with blow-offs. So you've got to be a bit careful about these ones. A big read here. We are hitting the targets again. And do you need to be scared? Well, you should be cautious, but there's no turn point on Tesla just yet. This level and around 300 are the clear next zones if this thing keeps running up. And while I still remain, eventually I think this thing will go lower. For now, it's 0DTE driven. And of course, we mentioned that since the 190s. And why? Because it became clear it was in this type of thing. You do not want to short this market without a good reason to do so. And we don't have one yet. Let's move over to Apple. What's going on with Apple? It's definitely slowed. So that's an all-time high here, 184 with the goggles. Then the goggles have pushed it back up again. And we are at a point where it's unable to make a new high while the rest of the NASDAQ is doing it. So the big players are slowing down, not only in options trade, but also we're seeing them slow overall from a point of view of price action. And these could be starting to show like those signs of topping. Do we have a swing trade change? No. You've got kind of like that high risk, semi-decent reward, high stop loss with the sell here. You're going to win that one probably only about 50% of the time. So you've got to be wary of those types of positions. And of course, keep that into, I guess in your own back pocket in terms of new all highs and stuff like that. When you see these types of things that are around a 50% move. The other one that I wanted to mention was that we had 60% of all of the options over the last 24 hours, unusually large activity, of course, were all calls. So again, the buy the dip, which has been the best scenario this year, continues to be now. I believe when a market comes down, no one will be buying puts generally. It will be all about buying calls. And that's a big switch from about 2 weeks ago. Huge psychological change here that's happening in these markets. Again, a point where we've seen it before. We did this in August. We did this in February. We've done this, of course. in other periods of time. These are all signals that we've seen before in these markets to be cautious around here. The DAX is doing its dance up here. I don't really see a trend change or anything, so I don't have too much opinion on the DAX. We'll come back to that when the US gives us a ride. And we can see, again, weakness in the Australian market driven by overall demand destruction plus our higher rates here, which are hurting our exports. So if you're an Australian, there's a few reasons not to like the market right now. US 2000, new high, comes into our pocket, hits our most traded zone. Interesting. So we've got now a new higher high. We now have some bases. This red box in here, I believe, holds the key of any turn on the Russell now that we've seen it. So we've got the high to the low to the higher high. We're wanting that to be busted, and that will probably instigate swing trade trends to the downside. For now, it's still bullish. If it does break out this area, just so we're fair with everything, probably next level is around that 1930 and those highs up here. So if you believe in the Russell, that's the next zone. Qs, huge amount of gaps. Wow. Probably some of the most I've ever seen. Maybe the most I've ever seen since I tracked them. A huge amount of Q gaps. There's probably another one in here as well that I haven't marked in. In fact, we can mark it together just so you can see how I mark these if they're there. So this one here was filled. This one here was not filled. So what you would do is you just copy and paste it, put it on the charts, check it on behind, and you can see here, I always do it to the close level because that's actually where the gap is. It's not the gap from the high price, in my opinion. It's the gap from the close. And that's the difference I usually go with. So there's an interesting little gap there between the Friday and the Monday. Another one to stack on the list. Now let's go to the futures market so we can see that my level here was tapped, my monthly level. So these are all huge wicks. Anywhere in here is theoretically resistance or supply or whatever you want to call it. Wicks hold orders, in my opinion. This is an area. And really, when we broke out of that zone, you might notice that we stopped kind of talking about trying to, really hammer this market without price action because we broke, we moved to the next level, and the next level is here. So now we're here. Now we're at the zone ahead of the FOMC and all of these types of things. What evidence do we have in hand of a turn? The answer is not much. Not much at all. So we really don't have any type of turn. We have, of course, the higher high. We have a low that we posted in so we can move our markets to those lows. And what I found interesting about the last 24 hours was more the way that it initially traded. So we saw it go low, then we saw it go high, making that higher high interesting. Then we saw it completely revert that, which is actually symptomatic of the market showing you the first move was false to suck people in. Makes a new low. Cool. Okay. This pullback, I expect. This action here, I expect. The action after that, that's the strange component. Generally speaking, what should have happened here is that the market should have done this and probably ended up around there to show us the weakness was in, the trap was set, all of those types of things. Very much watching this 14,960 high. We do know that we've kind of activated the potential here of some kind of miniature Wyckoff distribution. We don't have technical sell signals realistically. If you were short in there, I wouldn't blame you. If you're a day trader and you're just playing the stats, again, you're going to lose a lot of these because you're going counter trend, but it is what it is. So yeah, new lows would be very, very key here, I think, for bears over the next 24 hours and to see whether Jerome's pushing it down. As a swing trader, you're not even close to activation at this point. While this may give you a 2-hour switch of trend now with a low underneath that, so it could be important. The really big level is going to be 14,200 as well. So we'll keep updating you on these zones. We are at what I would call a critical big supply level, huge zone, certainly for the Qs. But we usually hit them at similar times that we hit the SPX. And really, I don't know if we're in an SPX short off. We've got a ton of gaps, very similar. There's actually a lot more unfilled gaps here than I've ever marked. But we've got a lot of gaps. We've got through the extreme zone. We melted it like butter. There was no turn zone. Remember, we had that 42.60 to show us a swing trade turn. We didn't get that as we saw rotation through the market. And the markets are accelerating away now from everything. So all the moving averages, everything's being accelerated. We're at the top of the pocket. We've gone through a monthly R2, pretty rare level to get through with ease. And we're certainly extended. This market is hyperactive right now for sure. Some people would call it crazy. I would just say it's just sucking as much money as it can to make as much as possible for no doubt the lobsters and the Wall Street boffins. So where is this market possibly to go? Well, the Qs are hitting into a zone. There's no doubt. But this particular US 500, do I really care about 43.70? Probably not as a key zone. Usually you would think this is possible, which is a 4,500 once you get these types of breakouts. I'll have a look at the weekly. The weekly close will show us a lot about what this market wants to do. Obviously, if it rejects fully, like other OPEX weeks, and we end up going down, then we'll have a pretty good idea. I think the swing trade is on to the short side. But at this stage, it all looks pretty much like it wants to keep going. I wouldn't try to hammer it too much just yet. If we go over to the big one, which is maximum pain, you can see here that max pain for 5.5 million units is starting to creep up. That's with people closing positions. You still have a lot of puts in the system, but of course calls are overtaking tons of areas. The big one will be the 440 call wall. And then I still think 430 is kind of like a call wall as well. So both of these areas, you wouldn't be surprised at all to see the market to drive down a little bit. After this week's OPEX, a lot of hedges are off. That's going to allow the VIX to also potentially start to spike again. Remember, there's too many calls on the VIX still at this stage. Move over to Bitcoin, no new low being formed, but it did come back to this little miniature supply. We're on a small time frame here of 2 hours. I'm still looking towards negativity on this market due to the SEC investigations, FUD, all of those types of things. Plus the price action keeps going towards the negative side, weekly, daily, etc. So at this point, we're negative on cryptos. We're obviously cautious on the stock markets across the world. We're looking at something on the NASDAQ like a potential turnaround here, but again, no price action yet. So we'll update and make sure to subscribe if you're interested in those things. For the news week ahead, as we can see here, we've still got PPI core coming out 1 hour before the market opens. And then we've got the FOMC statement followed by Jerome Powell's press conference. Often the time when the markets go one direction, then they go opposite when Jerome opens his mouth. I'm sure many of you have seen that before. We move down to retail sales, all the other information, central banks galore, and it's going to be still a very interesting week with extended volatility. If you enjoyed today's video, make sure to subscribe, smash that like button, guys, and of course, sign up for some free treat sheets if you're interested. Follow us on Twitter and anything else down below. Thank you so much for watching. We'll see you in the next one. Bye.